Hello, my name is Joe Hoyle, and I'm a co-author along with C.J. Skender of Financial Accounting. The textbook is in its second edition. This video looks at chapter number 9, and the purpose of chapter 9 is to talk about inventory. And so we're going to have a lesson here for a few minutes on inventory. The lesson is going to focus on two things. First, it's going to focus on a perpetual inventory system. A perpetual inventory system is one that keeps up with the inventory as you buy and sell it. In a perpetual inventory system, you should always know how much inventory you have on hand and how much inventory you have sold. We're going to couple that, though, with a conversation about FIFO versus LIFO. In a FIFO system, which is first in, first out, we make an assumption. And that assumption is that the first inventory that you buy is the first inventory that you sold. In LIFO, last in, first out, we make it the opposite assumption. The last goods that you buy are the first goods that you sold. So in this problem, we're going to have a perpetual FIFO system first, and then we're going to do a perpetual LIFO system to demonstrate the difference between these two inventory systems. Notice that on our first screen here, we're going to operate with FIFO, first in, first out. So it'll be perpetual FIFO. Perpetual, you keep up with the inventory. FIFO, you make the assumption that first in is the first goods out. Whenever I use a perpetual system, I always like to set up three columns. Inventory that you acquire, to indicate how much inventory that you bring in during the month or the year. The inventory that you have on hand. And the inventory that you have on hand, of course, is what you have right now. And then the cost of goods sold. We're going to keep up with those three columns, and at the end, we're going to know the ending inventory and the cost of goods sold. The problem here says that on Monday, we start with 50 units at $10 a piece. On Tuesday, we buy 50 units more at $12 a piece. On Wednesday, we sell 40. Thursday, we buy 50 more at $15 a piece. And Friday, we sell 40. So it's a pretty typical problem here. There's nothing unusual. The company is simply buying and selling inventory, and we're going to keep up with that inventory so that we have good information. On Monday, the company starts with 50 units at $10 a piece. Now you can kind of envision this being the inside of a computer system where you're keeping this on some kind of an Excel spreadsheet or some kind of a computer file. Now, that ends Monday. On Tuesday, they buy 50 units more. So we'll put down Tuesday. 50 units are bought at $12 each. Now, what do you have then? Well, you have the original 50 at 10, and now you have an additional 50 at 12. So you're keeping up with your inventory as you go along. If somebody asks you how much inventory you have 100 units. 50 costs you $10 a piece, and 50 costs you $12 a piece. We go to Wednesday. On Wednesday, we sell 40. Now notice in this problem, we have not yet mentioned FIFO. This is a FIFO problem, but we have not yet mentioned FIFO. FIFO comes into play when you sell the units. So on Wednesday, when you sell 40 units, then you make the FIFO assumption. If you had 50 at 10 and 50 at 12, and you sold 40, then you assume, and remember from our conversations, that FIFO always peels the inventory off in this direction. So you now have 10 at 10 and 50 at 12. That's a great demonstration of the FIFO assumption. You peel them off first in, first out. That means that you assume that 40 at $10 has been sold. And that gives you your cost of goods sold of $400. On Thursday, you buy 50 more units at $15. Well, you add in then 50 at 15. And what do you have now? Well, you have 10 at $10. You have 50 at $12, and you have 50 at $15. You're keeping a running total. Fairly quickly, you see that this process becomes redundant. You're simply going to be doing the same thing over and over again. Friday is your last day, and on Friday you sell 40 units. Now again, this is FIFO, so you peel these goods off first in, first out. How many do you have? Well, the first 10 are gone, and 30 out of the second group are now gone. So what you have left after you've peeled those off is you have 20 remaining at 12. The 10 are gone at 10, and 30 of the goods at 12 are gone, and you have 50 at 15. Where did they go? Well, 10 of them went to cost of goods sold at $10 a piece, and 30 went to cost of goods sold at $12 a piece. And that's how you do a perpetual FIFO system. What is the question going to be? Well, the question's always going to be, how much is the ending inventory? And this last sale right here is going to be your ending inventory. And that's $240 and $750. And I'm simply multiplying those out. If you add that up, your ending inventory is $990. When you're doing perpetual, that last sale is always your ending inventory. How much is your cost of goods sold? Well, you had one group that cost $400. The 10 at 10 cost $100. The 30 at 12 cost $360. So whenever you get ready to determine cost of goods sold, you have to add up this final column. That final column has all the cost of goods sold in it. So if we add up the 400, we add up the 100, and we add up the 360, then your cost of goods sold is $860. So if you can see how I got the 990 ending inventory and the 860 cost of goods sold, then you can do, and this is perpetual FIFO. Let's do the same problem, but this time let's do it with a perpetual LIFO system. Since it's perpetual, we'll start the same way. We'll have a column that is called inventory acquired. We'll have a column called inventory on hand, and we'll have cost of goods sold. The perpetual part looks exactly the same as it did before. Monday, you start with how many units? Monday, you start with 50 units at $10 each. That's the same. Tuesday, you buy 50 more units at $12 a piece. So come over here for Tuesday. We acquire 50 units at $12 a piece. What do we have now? 50 at 10 and 50 at 12. Notice that for FIFO and LIFO, until you start selling goods, they're going to look exactly alike. So the key day is going to be Wednesday, because on Wednesday you sell 40 units. So Wednesday, how many units do you have now? We had 50 and we had 50. We sold 40. LIFO always peels the goods off in this direction. So therefore, which 40 are gone? We assume it's the last 40. That's last in, first out. So what you have now is 50 at 10 and only 10 at 12. There's where the LIFO assumption is applied. When you get ready to say, what's the cost of goods sold? So what did we move into cost of goods sold? We moved 40 units at $12 a piece. That's $480. There is where, right there is where you see LIFO. We then go to Thursday, and as long as we're just buying inventory, nothing much changes. We have 50 at 15. So now we have 3 layers of inventory. We have 50 at 10, we have 10 at 12, and then we have the final 50 we just bought at 15. And that comes to the last day of our problem. On Friday, we sell 40 more. It's always the day you sell them that's important. So Friday, we sold 40. Which way are we going to peel the inventory? This is LIFO. We peel them off in that direction. So what do we assume about the 40 we sold? we assume it comes from this last batch here. It could have come from any. This is an assumption. So what do we have left after we make that assumption? We have 50 at 10. We have only 10 at 12. And then because of that assumption right there, we have 10 at 15. What's our cost of goods sold? Well, since we made the assumption here, since we made the assumption right there that it came from that batch, our cost of goods sold is 40 at 15, which is $600. When we get to the end of the year, or the end of the week, or the end of the period, how do we determine ending inventory? The ending inventory is always this last cell right there. And you can see that's 50 at 10, which is 500. That's 10 at 12, which is 120. And 10 at 15, which is 150. How much is our ending inventory? It's $770. You've applied LIFO and you've applied a perpetual inventory system. If we're talking about cost of goods sold, it's always the total of this last column. And you can see we have $480 there and $600 there. Our ending cost of goods sold is $1,080. That's how a company uses a perpetual FIFO system in our first slide and our perpetual LIFO system in our second slide. There's absolutely no reason you cannot do this. It just takes a little practice, but if you can do the practice, then you will be good at both FIFO and LIFO. Keep working. I want you to make an A.